Okay, thank you so much for being patient with me. This is Kathy Lien, and I want to welcome everyone to my session. Let me just go ahead and start this camera back up. Okay, wonderful. So once again, my name is Kathy Lien. I am the managing partner of BK Forex Advisors, along with my colleague Boris Schlossberg, and also the Director of Currency Research for GFT and FX360. So I do want to welcome all of you to my monthly FXStreet webinar. Now last month we talked about very short-term trading. I talked all about how to trade news and how to predict economic data and how to get into the trade before the event risk or before the news or piece of data comes out. Today, however, we're going to shift gears and we're going to talk more about what I consider long-term trading. Now, what I consider long-term trading is a position that's held for maybe a day or two or three, compared to short-term trading, which is a position held for 15 minutes, 30 minutes, an hour, a couple hours at the max. So in the world of Forex, everything is really kind of expounded in terms of time frames, in terms of leverage. So the same is true with our definition of short versus long-term trading. So this is for those of you that don't want to sit glued to a computer screen and rather put your trade on than go about with the rest of your life. Just to make sure everyone can hear the sound okay? Yes? No? Some people are not hearing the sound okay? There's sound? Okay, wonderful. So if you can't hear sound, please just turn up your microphones. And feel free to ask questions along the way because I'm sure if you have a question, someone might as well, and I'll try to get through them as we go through this session. Okay, before I begin though, I need to show you this disclaimer which basically says trading currencies can be risky. You can make money, you can lose money, so it's fairly important to know what you're doing. Hopefully that will help you today. What I'm going to talk about today is going to help you to do that. And if your questions are not related to what I'm talking about, we can address them towards the end, like the COT. Okay, so how many people feel like this when they trade? And I'm imagining that most of you are raising your hands at your desk right now because there's actually a lot of information out there and it's very hard to figure out, what is the best way to approach the currency market. Even in terms of the two big schools of thought, you've got fundamental analysis on one side and then technical analysis on the other. So it's kind of the battle of the fundamentalists against the technicians. But even within technical analysis, there's a bazillion of different types of things that you could look at, such as Elliott waves, Gartley patterns, Fibonacci's, moving averages, things like that. Now, I feel that many different types of indicators can serve similar purposes, and it's the point of trading, the point of developing a trading strategy is to find something that you feel comfortable with that works for you. Because I'm sure there's plenty of profitable Elliott wave traders or even unprofitable ones, and there are plenty of profitable, unprofitable Fibonacci traders or moving average traders. So it's just really a matter of finding something that makes sense to you and you feel comfortable with. So that's what I will attempt to do today, which is share with you my favorite technical indicator of all time and how I use it for my own trading. So we're going to talk about trend versus range, how to define that, how to properly pick tops and bottoms, 4 different ways to use my favorite technical indicator, which is the double Bollinger Bands, and then the art of the T1, T2 exit. Okay, so when it comes to foreign exchange for trading, there are basically 2 types of markets out there, and most of the time there are only 2 types of markets, and that's basically trend or range. A currency pair, can spend a couple of weeks, maybe a couple of months in range, and then it can break out very violently and significantly to the upside. Tom, yes, this is a very similar presentation to the one that I gave at New York. So if you did not or not able to attend the New York session, then you're getting a sneak peek here. So anyway, my point that I was saying is that we have markets go from trend to range, and in the Forex market, trends are actually much more dominant than range. And the reason for that is because in a foreign exchange market, we're trading countries and the outlook for a country. So the outlook for a country either gets progressively better or it gets progressively worse. Rarely do you see an outlook for a country get worse, better, worse, better, worse. And this is why trends are so dominant in the FX market. I mean, we'll take a look at some live charts later when I show you the trading tactics. But if you pull up any chart right now, like of the euro dollar, for example, you'll see that pretty much since the beginning of the year, since the first or second week of January, the euro dollar basically moved from 129 up to 140 over a very, very short period of time. So yes, you may have been able to pick a little bit of a top in the beginning of February, but you would have saved a lot of gray hairs and probably put yourself in a much more advantageous position by looking for opportunities to join the move. And that's why I think that, it's important to consider that range trading is not the only way to trade the FX market. However, with that in mind, some people come to the market and they like to, look for ways to pick tops and bottoms, and they love to range trade. The reason for that is because most people, when they come to the Forex market, they have traded or invested in stocks previously. So that means that when you usually trade or invest in stocks, Investing 101 teaches us to buy low, sell high, buy low, sell high. So we try to take the same type of mentality and translate it into FX trading, which can be the pitfall of a lot of traders, because even in this move in the euro dollar, imagine in the beginning of the year, the euro dollar was trading at 129 and it rose to 130, and you thought, 130 looks like, it's potentially getting, 130 looks like it could be a bit expensive. Maybe it's a good point to sell for further losses. Then it moved on to 132, and you thought, okay, 200 pips later, 130 looks like a good sell, 132 looks like a better sell. Then it gets to 135, the psychologically significant level, and then it goes on and on and on, and now the euro dollar is trading at 140. So if we simply try to think of it from a value standpoint, buy low, sell high, buy low, sell high, trading can be very frustrating sometimes. So there can be opportunities to pick tops and bottoms and ways to kind of align the edge in your favor, and that's what I hope we'll talk a little bit about today. So this is another chart of just showing you how strong a trend can be in the foreign exchange market. This is a chart of dollar yen, and if you pull up a chart of dollar yen right now, you'll see that the downtrend in dollar yen is very strong and it's been happening for a while. This is actually a weekly chart, so pretty much from 2007 to 2011, dollar yen's been a huge downtrend, and as a result, you could have possibly picked a bottom here, maybe even picked a bottom here, maybe even picked a bottom here, but once again, the trade would have probably been a lot smoother if you look for opportunities to sell rather than arbitrarily picking a top or picking a bottom in this specific case. So, with that in mind, let's talk about how to determine whether the market is in trend or range, because that's the number one question. If I tell you that the market's much more trending than it is range bound, it's still kind of important to think about when a market is in trend or it's in range. Now, there are many ways to do this, and I'm just going to start with sharing with you the most basic way that people determine trends versus range. It's not the way that I necessarily use, and I'll show you what that will be after I show you this. So, the most common ways to define trend versus range is to use something like the ADX, like the Average Directional Index. Basically, what the ADX does is it measures strength of trends. So, down here, you can see that we've got an ADX, and as a rule of thumb, usually when the ADX is above 20 and pointing upwards, it means that the trend of the currency pair is improving and it's growing, so it's moving into trend mode. If it gets really high and it's pointing downwards, it still means that the trend is strong, but it's losing momentum. So the ADX can help us determine whether the market is in trend or range. The simple moving average, and this is a 20-period simple moving average, can basically help us determine where the direction of the trend is. So generally, as a rule of thumb, if the currency pair is trading below the moving average, then we say that it's in an uptrend. If it's trading if it's below the moving average, it's trading in a downtrend. If it's trading above the moving average, it's trading in an uptrend. So that is basically the textbook way of determining range versus trends, as well as the direction of the trend. However, what I personally love to use is to use what I call the double Bollinger Bands. And I feel like the double Bollinger Bands provide us with a wealth of information. I'm going to talk about 4 different ways that you can use the double Bollinger Bands to help you trade. The first way will be to use double Bollinger Bands to simply define what the market is in right now, whether it's in trend or range, and then what direction the trend or range is in. And then I'll talk about how the double Bollinger Bands can help you pick tops and bottoms, find value, good entry points within a trend, and then how to enter into a new trend. So, what is a standard way to trade Bollinger Bands? There's a couple of different ways people use to trade Bollinger Bands. Some of them are used as like a breakout indicator or as a volatility measure. Sometimes people use it as an overbought, oversold signal. So I'll just share with you, one kind of simple way that people use the Bollinger Bands. So generally speaking, in terms of using the Bollinger Bands, you can see here that this is, sorry, I don't know why my slide, okay. So basically, what you see here is this is a standard Bollinger Band on a 4-hour chart. So whenever you have Bollinger Bands on your chart, you usually get, the second standard deviation Bollinger Bands. And so the typical way to use Bollinger Bands in an overbought, oversold signal is that every single time the currency pair it's an overbought or oversold territory because it's got 2 standard deviations away from its average price over 20 periods. So in that case, if you were to follow the textbook way of using Bollinger Bands, then what you would do is, every single time the currency pair touched the second standard deviation Bollinger Band in a downtrend, you would buy, and every single time it touched the second standard deviation Bollinger Band on the upside, you would sell. So all these red circles here are the losers, and the black circle are the winners. So here, if you sold here, you lost money. So if you bought here, you lost money. If you bought here, you had made money, lose money, make money, until you finally catch the bottom. Same thing here. We got lucky. The first touch was the top, but then you never know when it's going to be this situation where you get lucky and you actually catch the ultimate top, or it's in this situation where you start buying at 138.50 and it really doesn't turn until 136.50. So that's kind of the traditional way to use the Bollinger Bands. I'm going to look at this question real quick first from Genius FX. What time frames do you trade off intraday, and what's your average size, such as 20 pips, stop, 50 pips, etc.? I always see a lot of commentators have these 4-hour and daily charts that trade at 15 minutes and under for their trade. Well, right now this is an example. Typically, what I do is I trade off of 1-hour charts as well as daily charts. And, the average trade size really depends upon what the trade will give me. So Terry, why do we have 3 Bollinger Band lines when we set up? The reason is because you're also getting the middle line. And what I do is I usually delete the middle line because otherwise we have too many lines. And the middle line is not that significant for the purposes of what we're using today. So here's another example of using the Bollinger Bands to pick tops in the traditional textbook way. So let's say we, every single time it touches the Bollinger Band, you sell here, sell here, sell here, sell here. Basically, be faced with a whole bunch of losers. So even if we applied this to a daily chart, you see the same situation. That if used, a lot of times with a lot of technical analysis, if used the textbook way to analyze the charts, it can lead to more frustrating trades than profitable trades. So that's why I have devised the double Bollinger Bands. I've been using this for years, and I love it so much. I mean, I use it every single day in my own trading activities. So what are the double Bollinger Bands? Whenever you add Bollinger Bands on your charts, you'll get the default, which is the 20-period 2 standard deviation Bollinger Band. What I've done to create the double Bollinger Bands is I've added a 20-period 1 standard deviation Bollinger Band. And what this gives me, the 2 Bollinger Bands is the outer lines, and the 1 Bollinger Band is the inner line. So that'll make a lot more sense when once we look at the charts and you see exactly how the Bollinger Bands are laid out on the chart. So using the first way to use the Bollinger Bands is simply for informational purposes only, which is that the Bollinger Bands can help us determine whether the market is in trend or range, and how strong it is maybe in that trend or range. So this is basically the double Bollinger Bands on the chart. And if you take a look here, the outside lines, like I said, are the 2nd standard deviation Bollinger Band. And so the 2nd standard deviation Bollinger Band is what you get as a default on your chart. And then I added the 1st standard deviation Bollinger Band in here. So the first thing that the Bollinger Bands define for us whether we're in trend or range. And so my personal rule of thumb is that when the currency pair is trading the 1-2 band, the upside, I say that it's in an uptrend. When it's trading in the 1-2 Bollinger Band, the downside, it's in a downtrend. And anything in between is in what I call the range trading zone. So that means that when the currency pair is in the 1-2 band, the upside, I'll be looking for opportunities to buy. When it's in the 1-2 band, the downside, I'll be looking for opportunities to sell. Anything else in between, I'll be waiting for new direction, or I'll be looking for one of my turn trades, which we'll talk about next. This is another example of dollar yen. You'll see when it's a downtrend, the price usually likes to remain contained within the 1-2 band when its trend is strong. And then, when it's an uptrend, the complete reverse. And this is the last example, Odd Dollar Daily Chart. Once again, if this trend is very strong, then it likes to remain in the 1-2 band, the downside. And if it actually starts to rally, then what it may do is it'll enter the uptrend zone. So the first way that we use the Bollinger Bands is give us information. But then now the question that you should ask me is, how do we actually use this to trade? So one of the ways to use this to trade is to use the Bollinger Bands to help you pick tops and bottoms. Okay, it seems like I've got a couple of questions on how do you create both bands. So let me actually go to a live chart and show you quickly how I create the bands. And every charting package is different. So let me remove my bands here. Every charting package is different, but it's pretty much the same way. So we're all on the same page. Everyone can see my chart right now. So how do we add on the Bollinger Bands? This is an e-signal chart. In e-signal, basic studies, we go up to Bollinger Bands. Usually it involves a right click regardless of what charting package that you use. Okay, so you'll see that the default is 20 periods, 2 standard deviations. And I like my lines black. So yeah, this is for any time frame. I like my lines black, so I'm just going to change them to black. And I get rid of the middle line because it's not necessary. So now I have the outside line, which is a 20-period 2 standard deviation Bollinger Band. So I'm going to add in the middle line, or sorry, the inner lines, which is the first standard deviation Bollinger Band. So I go back and I simply add on another set of Bollinger Bands. So it's fairly simple in any charting package. And usually once you do it once, the charting package will remember it. So we still have 20 periods, but instead of 2 standard deviations, we change this to 1 standard deviation. And once again, you know, I just like to have all my lines black for consistency purposes. Get rid of the middle line, apply, there you go. Now you have the 2 bands. We'll revisit this chart once I show you the first strategy. Any questions about that? In terms of your specific charting package, MT4, I don't know how to remove it, but it shouldn't be very difficult to find. Every charting package I use allows you to remove the middle line. Okay, so anyway, how do we actually use this trade? The first way to use this to trade is to use the Bollinger Bands to help us pick tops and bottoms. So this is one of the charts that I showed you initially. And the circles were basically the winning and losing trades if you use the Bollinger Bands to simply pick tops and bottoms, meaning that every single time it touched the lower Bollinger Band, you would buy. If it touched the upper Bollinger Band, you would sell. I'll go into the charts in a second, Emma, because I haven't even shared with you yet how to actually trade the strategy. So back to this chart. You know, this is the standard way of using the Bollinger Bands. Now, as you can see, we have a lot of losing trades, we have a few winning trades, and a lot of frustration there. Instead, if you added on the first standard deviation Bollinger Band, this is what you get. Because remember, in the beginning, I told you that, you know, as a rule of thumb, when the price is trading in the 1-2 band on the downside, it's in a downtrend. When it's trading in the 1-2 band on the upside, it's in the uptrend. But when it turns out of it, this is what I call the turn trade. It means that the downtrend has completely exhausted itself and the currency pair is churning. So the currency pair is churning, and what you'll see often, and we'll go to live charts after I show you some static charts with clean examples, is that when it turns outside the Bollinger Band and the currency pair closes above the first standard deviation Bollinger Band, in this case we're selling off, selling off, selling off, selling off, selling off. It's finding a base, it churns, it closes outside of the first standard deviation Bollinger Band, and then what you'll find is that oftentimes the currency pair will like to touch the Bollinger Band on the other side at minimum. So once again, we're in this uptrend here. When the currency pair finally turns outside of the Bollinger Band, and this is a larger candle, but still, it ends up touching at minimum, the first standard deviation Bollinger Band on the other side. So it's selling off, selling off, selling off, selling off, selling off, the candle closes outside of the first standard deviation Bollinger Band, and it takes a little time, but eventually touches the Bollinger Band on the other side. So let me take a look at another example. This is the daily Aussie dollar chart that I showed you earlier. And once again, this is the textbook method. If you simply sold every single time it touched the Bollinger Band, you would have a bunch of losing trades before you actually hit that winner. And, you know, it can also be very frustrating, as you can see in this example over here. So what happens when we add on the first standard deviation Bollinger Band? When we add on the first standard deviation Bollinger Band, we avoid these losing trades, and we avoid these kind of false moves or false overbought signals. We let the currency pair rally. We let it show a bit of weakness first. We wait for it to close outside of the first standard deviation Bollinger Band, and then we target the first standard deviation Bollinger Band on the other side. So once again, it sells off into the downtrend zone, closes outside of the first standard deviation Bollinger Band, targeting the other Bollinger Band on the other side. So we let it rally. So we see the currency pair rally over here, closes outside of the first standard deviation Bollinger Band, targeting the Bollinger Band on the other side. And you see that here as well. Now you do leave some money in the table in the sense that if you were able to pick this top here or this top here, you would have gotten more pips out of the trade. But hindsight is always 20/20. It's very easy to say if I had picked this top here or this bottom here, I would have had a better trade. But when it's rising like this or when it's falling like this, it may not be so easy to see or to tell that that is happening at that time. So here's another example on the 1 hour chart. So currency pair is selling off, selling off, selling off. We wait for it to close outside the Bollinger Band, targeting the Bollinger Band the other side. Wait for it to close outside the Bollinger Band. This pretty much gets over there. Rally, rallies, rallies. We wait for it to close outside the Bollinger Band, targeting the other side. So here's a very good question on time frames. I showed you the strategy on 4 hour chart, 1 hour chart, daily chart. I do find that it works better in the daily charts, but I think it works pretty well going down to 1 hour. I wouldn't really go down beyond 30 minutes on this strategy. And then this is just simply, a daily chart showing you how the currency pair is selling off, and when it turns, it likes to touch the Bollinger Band on the other side. And this also shows you a similar move in dollar CAD. But I'll go to live charts, and we can talk about this in a little bit further detail. Which trigger the order? What triggers the order is when it closes outside of the middle band. So it has nothing to do with crossing the upper band. So let's say we're selling off, selling off, selling off. You want to go from this area here between these two lines, and you want to see the candle close in this region here, which is above the first standard deviation Bollinger Band if you're looking to buy a turn to the upside, and below the first standard deviation Bollinger Band if we're looking to sell a turn to the downside. So in terms of the strategy, you have to wait for the close. So that means that most of the charts close at 5 p.m. That's the barometer that I use, 5 p.m. New York time. So I wait for it to close after 5 p.m. New York time, maybe sometimes 4:30 to put on my trade. Very good question, Mitch. Every single time someone shows you a strategy, you should ask the question, where is your stop? Typically, with this type of strategy, my stop is at the swing low or the swing high, as long as it's not more than 60 pips. If it is greater than 60 pips, usually I just might use a money stop, because by that time, usually 60 pips puts it back into the 1-2 band, so the reason for why I had gotten the trade is no longer valid anyway. If it's a very large candle, like some of the ones that we saw previously, then I may forego the trade. So let's just take a look at a live chart to see the strategy in action. So this is my e-signal charts. So right now, this is a chart of dollar yen. And let's see if we could zoom in a little bit. Okay. So hopefully it's not too zoomed in for you. Alright, what you will see here. Okay, so we're in this uptrend here. Bollinger Band closes. The candle closes. It goes in the uptrend. It closes outside the 1-2 band on the upside, and then that's when you would sell, targeting the Bollinger Band on the other side. In this case, you would not place a trade at all. You would wait for it to sell off, sell off, sell off, sell off. Here, you wait for it. You see that it closes outside the Bollinger Band. You buy, but you get stopped out. That's okay, because not every single trade will be a winner. Then later on, we try again when it closes out the Bollinger Band here, and this time it touches the Bollinger Band on the other side. Rallies, rallies, rallies. This one, somewhere in this region here, you were sold. Either you sold this candle or this candle. and basically targeted the Bollinger Band on the other side. And then here, when you're in a downtrend, it closes outside of the Bollinger Band. This one takes a long time, but eventually it touches the Bollinger Band on the other side, and it's probably a scratch trade. This one, it closed outside the Bollinger Band, and then touched the Bollinger Band on the other side. This one closed outside the Bollinger Band, touched the Bollinger Band on the other side. So, even this live chart in dollar yen, you can see that it works quite well. Okay. You mentioned the 20-minute, can you show some strategies with this? I'm not too sure what you mean by the 20M, so I'm just going to move on. So, using Bollinger Band to buy at value. That's the other way to use the Bollinger Bands. The first way we talked about using the Bollinger Bands is to pick tops and bottoms. And I encourage you to do this yourself. If you pulled up a chart of dollar CAD or something like that, you'll see that there's a very similar dynamic that has happened in the currency pair. So that was, for those of you that insist on picking tops or bottoms, one way to do so would be to use the Bollinger Band, what I call the turn trade. In a live trade, how do you determine where the Bollinger Band is going to be on the other side of the exit? Well, you can see that, Miss Pip. Like, if we go back to our live chart, I know exactly where the Bollinger Bands are at this moment. And that's where I will kind of talk a little bit about the T1, T2 exit. Because sometimes in these moves, it's very far away. I mean, like, let's say you sold here, it's 83, and this is a little bad example because dollar yen kind of have a smaller range lately, but sometimes the move can be very huge. So if it's already moved like 150 pips in your favor, maybe you should start trailing the stop and locking in some of that profit. And then, you can keep on trailing the stop, hoping to capture one of these big moves over here. Do you need just price action or actual close between the 1-2 standard turn trade? That is very, very important, Thompson. I'm glad you asked this question. We actually need the candle to close outside of the two bands in the bottom or the two bands in top in order for it to set up as this turn trade. It must be a close. Second, is there a risk to reward that you're looking for? Well, usually I will employ what I call a T1, T2 method of taking this trade. That means that in the first half of the position, I will usually exit out at 1 times risk or 1.5 times risk. And then I'll keep on trailing my stops to take advantage of what I hope to be one of those larger moves and become one of the more dominant trend moves in the market. Neil, I know this question was asked earlier in terms of expectancy for strategy, but because of NFA regulations, I can't give any specific numbers in this session. But I encourage you all to put this stuff on your charts yourself, and you can see through your own eye whether this works or not. So let's move on, because I have 2 more strategies to show you before we end this session. So the next way is to use the Bollinger Bands to buy at value. So let me maximize my chart again. So we basically talked about how we could use the Bollinger Bands to pick tops and bottoms, and how the Bollinger Bands also tell us whether the currency pair is an uptrend or a downtrend. But in order to join a trend, you have to pick what I call good value points, because sometimes it's difficult. You're watching a currency fall, or you're watching this move in the Eurodollar that's rising, and you're thinking, it's come quite a bit of a ways, in a very short period of time. I mean, the move from last week to today took it from like 137 up to 140. Is it getting kind of expensive? I know the ECB plans to raise interest rates, and the outlook for the Eurodollar should be more positive. But you may think to yourself, it's kind of expensive and pricey. It may be kind of expensive and pricey to buy the Eurodollar right now, especially as it's showing some struggle to break above 140. So what should you do? And that's where the Bollinger Bands come into play. And that's where it helps you look for good entry points into a trend, especially when you have a strong belief that the Eurodollar may continue to rally. but you don't want to pay up for it. So that's what we use the Bollinger Bands for. So the way we do it is, what you'll see here is that, let me show you a clean example here, then we'll go back to the other examples. When a currency pair goes into a new trend, so in this case, it is in the an uptrend because it's trading in the 1-2 Bollinger Band on the upside. So value points to enter the trade would be on what I call the retrace to the first standard deviation Bollinger Band. So it's rallying and you want to wait for it to retrace. We want to wait for it to touch the first standard deviation Bollinger Band. And that's a good value point, in my opinion, to enter the trade. So here, the blue circles, all the circles are places where you would enter the trade. The blue circles are the winners, the red circles are the losers, so sometimes you'll get stopped out. So let's work backwards, because these are cleaner examples that will help you understand, and then we'll go through the rest of this chart. So here, currency pair enters into an uptrend, but you don't want to pay up for it, because, it rose to maybe 135 in this case. So it goes into a new trend, and then you wait for it to retrace to the first standard deviation Bollinger Band, and that's when you would enter for a continuation move. Here, it retraces the first standard deviation Bollinger Band, and these are good value points to enter for a continuation move. So this is where you would enter, this is where you would enter, this is where you would enter at value, and you try it again at this point, you get stopped out, but that's okay, because, with these types of strategies, you want to have more winners and losers. You're never going to have 100% winners with any type of strategy. So, and if someone shows you that, they're lying to you. So let's look at the another example. So here it enters in a downtrend. In this case, we get stopped out, no big deal. But when you do capture a big trend, it can be quite good. So here's a downtrend. These are all points to enter at value to basically participate in the downtrend. Let's look at another example. This is another example. I use these only on daily charts. This is an example of dollar Swiss. So it goes into the uptrend. So rather than just buying at this price here, because maybe so expensive, it may be getting towards parity in this case, you want to wait for it to retrace to the first standard deviation Bollinger Band. And all of these circles represent the retrace, which is good value points to enter. Moves into a downtrend rather than selling arbitrarily. You want to enter on these different retraces. So you want to wait for it to retrace to the first standard deviation Bollinger Band, where these circles are, and that's where you would enter to sell at a good price. And your stop will be at the dotted line, which is, or at least the stop that I use is at the dotted line, which is a 15-period simple moving average, which tends to contain the price action quite well. So let's take a look at some live charts. All right, let's take a look at the euro dollar, because we were just talking about that earlier. Okay, so we are looking at the euro dollar chart right now. And let me just move this box out of the way. Okay, so we're looking at this euro dollar chart. So let's kind of zoom in a little bit so you can see clearly. So, euro dollar enters into here. Basically, even if it was a short-term trade, the touch to the first standard deviation Bollinger Band still would have provided, some small, decent opportunities here, because these candles are basically about 100 pips wide. So if you waited to retrace to the first standard deviation Bollinger Band, you may be able to capture maybe 50 of that 100 pips buying at value. So this is a retrace to the first standard deviation Bollinger Band. There's like 3 or 4 opportunities over here. Here, same thing, the retrace to the first standard deviation Bollinger Band. Whenever it touches this lower line over here is good value points to enter. And then you see that also when the trend's in this downtrend here. And then they're really, really nice when it's in an uptrend like this, where you do see that the trend is very strong. It may be very difficult to, pay up for it because you're looking at it rising, rising, rising. So what I would do instead is I would wait for it to basically retrace and buy here instead, and buy here or buy, here as good value points to enter into the trade. And then we talked about the 140. Earlier I talked about how, 140 seems to be a nice little contention point for the euro dollar. It may be looking expensive. It's come a long way. So what would I do? What would I do is I would wait for it to retrace to the first standard deviation Bollinger Band at around 138.65.70, and that's when I would look to buy the euro dollar if you haven't gotten in already. So any questions about using the Bollinger Bands to find value points of entering into the trade? And if you have any questions about how to set up the Bollinger Bands, the beginning of the session is recorded, does show how you had to do that. Okay, so the last one I want to show you, how do we decide if this is a continuation of a trend or a turn trade? Well, basically, if it closes outside of the first standard deviation Bollinger Band, then, there's a greater chance it's a turn trade. The whole idea that you're trading there is that it will hold the first standard deviation Bollinger Band. And that's also kind of why you can't trade two strategies at one time. You pick one, and if you're a tops and bottoms picker, then you basically just want to look for the turn trade. If you are a continuation trader, then you probably just want to wait for the retrace trade. So let's go into this. Using Bollinger Band to enter into a new trend. I'll talk about that later, about fundamentals, after I talk about this. So using Bollinger Bands to enter a new trend is the last way that I want to share with you is basically the last Bollinger Band strategy that I want to share with you. Trying trader, the counter trend trade was the first one that we talked about. Okay, so once again, when the currency pair is trading in this area here, it's in an uptrend. And when the currency pair is trading in this area here, it's in a downtrend. This is a daily chart. It says right here, pound dollar daily chart. But before the currency pair gets into this area here, before it gets into an uptrend or downtrend, it has to enter the 1-2 band. And this is what we're trading with this getting into a new trend strategy. This is a shorter term trade than some of the other ones. You sometimes have to be a little bit more nimble with this one. But what you would do here is that you wait for the currency pairs trading in the range trading zone. And what I would do is I would wait for it to pierce into the 1-2 band, the upside. The currency pair pierces into the first and second standard deviation Bollinger Band. That's where I would go long for a continuation. Sometimes you get a one candle continuation only. Sometimes you get a multiple candle continuation. And this is what gets you into a new trend. So once again, selling off. It pierces into the 1-2 band. May be difficult to sell in this case, but usually, such strong moves such as these is caused by a reason and a certain sentiment change in the market. And so that too has a, nice chance of leading to continuation. Here, it pierces to the first standard deviation Bollinger Bands, and we actually get stopped out, but that's okay because not every single trade will be a winner. Then it kind of consolidates in the middle area, pierces into the first standard deviation Bollinger Band. Very good question. Should we wait for a pierce or should we wait for a close? It must be a candle close. So this candle pierces and closes in this upper band area between the 1-2 bands to the upside, and then you see there's a continuation. This one is a one candle continuation. That's why we have to be kind of nimble. Because with this one, it was a nice easy trade. It just went on and on and on. But sometimes you're not so lucky. You only get a one candle continuation. And, since this is a daily chart, it's still a fairly large move. But that's why we have to be realistic, and that's why I like to use a T1, T2 method of exiting the trade, which I'll talk about last. And here's the final example. It pierces into the first standard deviation Bollinger Band, continuation. Here's another example. In this case, we've got the Kiwi dollar, also a daily chart here. Okay, please parameters for the Bollinger Bands. If you missed the beginning, the parameters for Bollinger Bands are 20 period 1 standard deviation and 20 period 2 standard deviation. And in this case, we are using the daily chart. Kathy, the overall shape of the Bollinger Bands will define if you enter a sell entry when the candle closed below. Basically where it is, if the currency pair is trading and it moves into the two upper bands, then it tells you it's an uptrend, so you'll be looking for buying opportunities. When it goes into the lower bands, you'll be looking, it tells me that's in a downtrend, so I'll be looking for, opportunities to sell. So back to this pierce into and getting into new trend strategy. Here, the currency pair pierces into, it goes from the range trading zone into the uptrend, candle closes, and then we buy at the next candle or the next day for continuation. Here it pierces, it pauses a bit, it pierces and it closes. We sell, it pauses a bit for the next day, and then the following day has a nice low continuation. This one we get stopped out at, no big deal, because there will be winners and losers, and you can see that we've got more winners and losers on this chart. Pierces into the Bollinger Band, closes. Next 1 or 2 days we've got a nice low continuation. Same thing here. Pierces into the Bollinger Band, closes, multiple candle continuation, stopped out here, continuation, continuation. And if you pulled up the latest Kiwi dollar chart, you'll see that this move, which started over here, has taken the currency pair from 77 cents all the way down to its current rate of about 73.50. Okay, so any questions about the pierce and continuation trade? Alright, so I'm going to show you a couple more things, wrap up, and then take questions. So, in general, with a lot of these different trading strategies, you can increase your chance of success by keeping an eye on economic data. For example, if economic data is on your side, then there's probably a greater chance that the trade may work out. For example, if you know that the ECB is really bullish and there's no one quite as bullish and hawkish as the ECB, and you see a buying opportunity in the euro-dollar because it retraces to the first standard deviation Bollinger Band, as I showed you earlier, that's a higher probability trade than if the ECB was not hawkish and they're like everyone else and just kind of dovish. So you always increase your chance of success by keeping an eye on data. It also helps if, for example, tomorrow you may think that we have a really good German factory orders report that's going to be released, and you see some sort of positive euro-dollar trade. That all will only help your trade because it's what I view as having as many stars lined up in your favor as possible. So what is your edge in FX? That's kind of where you want to bring that into here, because some people like to use other things such as technical analysis patterns, or they'll like to use, they'll ask me what happens if we have other support and resistance levels at a certain rate, or they'll ask me, what do you look at multiple time frames to see if we have confirmation? That is where you want to, that is basically where you want to add your edge, whatever you're good at. And I like to provide people with a strategy that I feel works fairly well by itself, and I always encourage enhancements through your own, by adding your own things, because if the retrace is to a significant support level, that probably only increases the likelihood of the trade being good. At BK Forex Advisors, which is the service that I run with Boris Schlossberg, our edge has always been predicting economic data. And so we always like to position our clients ahead of some of these strategies, ahead of significant economic releases. We'll always avoid things such as non-farm payrolls, central bank rate decisions, anything without forecasts. And we usually trade things like retail sales, inflation numbers, employment numbers of other countries. And we basically, provide these type of fundamental biases and trades to our clients on a daily basis. And we always avoid data from Japan and Switzerland because, no one really pays any attention to that. So this is just kind of an example of, of how we predict trades proactively. And this is what I shared in the session that I did last month. basically, in this example, we're just looking at GDP. You saw, this is German GDP numbers being released. You can see that the number came out weaker than expected. The annualized rate grew 4% instead of 4.1%. The quarterly rate grew 0.4% versus 0.5%. One of the things that we did was we positioned our clients ahead of this data, and to basically, we're looking at the underlying components, such as the trade numbers and the consumer spending numbers. Basically, what makes up GDP are two things: trade and retail sales. And as you can see here, the trade numbers for Germany, and these numbers are released before the GDP number, was pretty much, on average similar to the trade numbers in the third quarter. But as you can see here, retail sales was very weak in the fourth quarter compared to the third quarter. That the data is probably going to be euro bearish, and it would basically, lead to losses in the euro dollar. So I saw in my charts at that time that we had a short euro dollar trade, and that's how we would combine fundamentals and technicals. We take some of these ideas of predicting economic data that we share with our clients every single day, and we implement them with some of the strategies that we follow. The art of T1, T2 exit, I touched on this already, which is that in the beginning I talked about how trends are very, very dominant in the FX market. So we need to take advantage of them. In order to take advantage of them, one way to do so would be to use a T1, T2 exit, which means that you have a short first target and a long, second target. There's a whole discussion that we can have about this. I'll save it for next month just because we really don't have too much time to go on to this without eating into our Q&A. So last, what I want to leave you with is I encourage you all to check out our website, bkforexadvisors.com. We have, completely audited numbers there and samples on the site as well, and shows you our performance against the average Barclays Currency Managers Index. This is what I send to my clients every week, and then I also send them an update every day with a specific trade suggestion. And you can see here it talks about, what my confidence is, whether I'm bullish, what my potential trade is, and the views. If you like a copy of this week's calendar, I'd be more than happy to send it to you. All I need you to do is send me an email. You can either reach us by going through the contact box at bkforexadvisors.com, just telling me that you want a copy of this week's event risk calendar, take a look at how we look at economic data, or you can email us directly at contact@bkforexadvisors.com and say that you want the calendar for this week. And then this is a live chat room that we have for our clients and while we have our live trades. And we also have a forum for those of you that like trading discussions. So with that, I'm going to open up the floor to with the stocks, these strategies. Okay, so the first strategy, picking tops and bottoms, we use swing high, swing low for the stop. The second strategy, using Bollinger Bands to buy at value or to sell at value. Usually I will use a stop about 60 pips because usually it's a pierce trade. If once it goes into the middle area, then after that's using Bollinger Bands to enter a new trend. I use a 60 pip stop. Because usually it's a pierce trade, it enters into a new trend. By the time it sells off by 60 pips, it's already outside and it failed its attempt to go into the 1-2 band. So that's why I think 60 pips is a sweet spot there. And then the second strategy, using Bollinger Bands to buy at value, we had the 15-period SMA as our stop. You place the stop at 50 SMA. No, it's the 15 SMA. Let me go back to make sure I got some of these. If oil is rising, what is the dollar index and euro doing? Usually, weaker dollar leads to higher oil prices, and euro lately has been had a positive relationship with oil. Did not Bollinger say that 20 period is too big and that around the 10 period was his preference? Everyone trades differently. John Bollinger, I met him in Singapore a couple of months ago, and he had never looked at the Bollinger Bands the way I look at it. So there's always, enhancements that people can make to different types of technical indicators. Will I have another webinar here? I may next month, but I believe Boris is having a webinar next week, if I am not incorrect. It'll be advertised on the FXStreet site. He's much more short-term than I am, so I definitely encourage you to attend that session. And if you follow us on Twitter, you'll get all the information on when we're doing our webinars. Sorry, my Twitter thing is @KathyLeanFX. Bettina said, I will enter to buy the Eurodollar 138. How do you get that number? Basically, it's the retrace to the first standard deviation Bollinger Band. And then Vicky says that Boris has a webinar on the 14th. Why did you choose the 20s for the Bollinger Bands? Because the 20 period, I'm not too sure what you mean by 20s. The 20 period is the default usually on the Bollinger Bands. Okay, any other questions? Alrighty. So, I don't know how long it will take for the webinars to be archived, but it won't take long. So Vicky's saying tomorrow. How do you remove the middle band, JP? It really depends upon your charting package. Usually, there's a middle line selection. You just uncheck it, and you can remove it that way. So I hope that you have enjoyed this session. Like I said, if you would like a copy of this week's calendar, just go to bkforexadvisors.com and click on contact, or just go to contact@bkforexadvisors.com and ask for the calendar. We'll probably send it out later today or tomorrow. Okay, thank you so much. It's been a pleasure.